Alright, you guys, we are going to start the 60-minute tax training here in just a second. Let's see. Alright, so we are going to do the 60-minute tax training where we are going to talk about taxes in general. But before we get started, I wanted to do the introduction. My name is Angelica Robinson. I am an enrolled agent, but I am not your enrolled agent. So anything you see in this video is not tax advice, legal advice, or anything. Please get with your tax preparer, your CPA, your accountant, whoever. All of this is for educational purposes only. Over the next hour, we're going to focus on delivering clarity, value, and real-world insights on the tax process. So we're going to break everything down so that you can understand it a little bit more. So let's talk about it. First up, we are going to talk about introduction to taxes. Alright, I need you to put a 1 in the comments if you guys can hear me. Let me know if you guys can hear me real quick before I get started and start diving in. Alright, let me know if you guys can hear me. Put a 1 in the comments. Let me know. Alright, so let's talk about introduction to taxes. The first thing is you're going to hear the term enrolled agent. And I know a lot of people probably don't know what that is. So an enrolled agent is actually a licensed tax specialist licensed by the IRS. Okay? So we have the opportunity to talk to the IRS for you and to negotiate, lower your tax debt, audit, whatever it is. So our primary focus is taxation. We are able to represent taxpayers before the IRS, handling audits, collections, and appeals. And to become an enrolled agent, you actually have to pass one of the IRS exams, which is a 3-part process, or even have IRS experience. So you have to be able to take those exams or work for the IRS. So there are certain stipulations that you have to pass to become an enrolled agent. Now there are some strict ethical standards and some continuing education stuff that we have to do every year. But we are actually verified and authorized by the IRS. So there is a huge difference from a regular tax advisor or tax specialist. All of that falls under a different category. These tax advisors that are out here now are not recognized by the IRS, I guess you would say. They're not certified. They go through training, they get their P10 number or EFIN, and they are able to do taxes with the education credits that they have. Enrolled agent is above that. They are expected to know more knowledgeable, and are able to actually communicate with the IRS on your behalf. So, why is understanding taxes essential for everybody? It has a major financial impact on you. Taxes is probably one of the most expensive things that we pay for. And understanding them helps you to legally minimize your tax liability. It leads to informed financial decisions. When you talk about taxes, you not only think about buying a property, retirement planning, investments, starting a business, and everything else in between. So, for an example, choosing between a traditional IRA and a Roth IRA can lead to a huge difference in taxes. So understanding it now while you are trying to pick and choose which one's best for you is going to make it matter in the long run. Now remember, knowledge is power. So understanding taxes help you shift from feeling reactive or anxious to being proactive and confident in this. The goal isn't for you to become a tax expert overnight. It's to help you start to understand it and to build that confidence and giving you the knowledge to know what questions you need to ask. So, as we have covered the why, we're going to move into what and give you some tax concepts that everyone should know. Tax basics. We are going to break down some of the core tax concepts. These are what I call the building blocks. Gross income. This is all of your income from all of the sources unless it has been exempt by law. Adjustments. These are specific deductions taken above the line before calculating your adjusted gross income. For an example, this includes like your student loan interest or even certain retirement contributions. Then we have your adjusted gross income, which some people would just say or call it AGI. This income is minusing those deductions. So you take your gross income, subtract those adjustments that we just mentioned. Now, AGI is crucial because the number is used as a threshold for many other deduction or credits that you may receive. Deductions. You're either going to take the standard deduction, which is a fixed amount based on your filing status. And this amount actually changes every year due to inflation, and it is provided by the IRS. Or you're going to take your itemized deductions. Itemized deductions are specific expenses like your qualifying mortgage, interest, charitable contributions, or even medical expenses that is above that threshold limit. So, in order for you to take that itemized deduction, your deduction amount has to be greater than that standard deduction amount that the IRS is giving you for it to make sense. You would want to take the largest one possible. So if your standard deduction amount is higher, you're going to want to take that one over the itemized deduction amount. Taxable income. This is your AGI, your adjusted gross income, minus your standard deduction or your itemized deduction. This is going to give you the actual amount of income your tax is calculated on. Tax liability. The amount of tax calculated based on your taxable income using the tax brackets. And, of course, tax credits. These are what everybody is looking for. They provide a direct dollar for dollar reduction of your final tax liability. These are more valuable than the deductions. All right, and then it is also important to know the difference between the types of income because they could be treated differently. Earned income, such as wages from a job, W-2, salaries, tips, and even self-employment earnings. Investment income, such as interest, dividends, capital gains from selling assets like stocks or cryptocurrency. passive income, which is often referred to rental properties or limited partnerships. And then you have other income, which could be your unemployment benefits, gamblings, and sometimes alimony. And your filing status. I know you heard me mention it before when we were talking about the standard deductions. There are a number of filing status that you get to choose from. Single, married filing jointly, married filing separately, head of household, and what they call qualified surviving spouse. Each filing status has its eligibility rules. So your filing status determines your standard deduction amount and the tax brackets applied to your income. So everybody's situation is different. You have to choose the filing status that best fits your situation. How are taxes calculated? Well, I'm going to break it down as simple as I can. The U.S. uses a progressive tax system, which means the income is taxed in tiers or brackets. Higher income faces higher tax rates, but only on the income that's falling within that specific tax bracket. So you'll probably hear me mention the marginal tax rate, which is the rate on your last dollar earned, and your effective tax rate, which is your total tax divided by your taxable income, also referred to as your average tax rate or your average rate. Now that we have those tax basics, we're going to dive into deductions and credits in more detail and how they actually work to reduce your tax bill. All right, so let's revisit tax deductions, which works by reducing your taxable income. Now remember, deductions lower the amount of income the government taxes. Their value depends on your tax rate. Common itemized deductions, which is claiming your Schedule A if it is more than your standard deduction. So medical expenses is a big one, and that is it has to be at least 7.5% of your AGI to claim it. Then you have your state and local taxes, which includes your property taxes, sales taxes, but it's capped at $10,000 per household. Then you have your home mortgage interest, which actually is subject to your income limit. And then charitable contributions. There are rules that apply for cash and non-cash donations, which we will cover in another video. There's also above the line adjustments that reduce your AGI, which anyone can take if they're eligible. So you have your traditional IRA contributions, your student loan interest, your health savings account or contributions, and then you take 1/2 of self-employment tax. Now, each of these have different rules and regulations in order to claim them. We will dive deeper into another video on that. And for businesses, business deductions cover your ordinary and necessary expenses like supplies or even your home office deductions. Next, tax credits. These provide a direct reduction of the taxes you owed. Credits are generally more valuable than your deductions because they reduce your tax bill dollar for dollar. Some of the examples of your tax credits would be like the child tax credit for qualifying children, the earned income tax credit for lower to moderate income workers. With this one, just know that you do not have to have a child to qualify, but there are some income restrictions. education credits like the American Opportunity Credit or the Lifetime Learning Credit. You also have the Child Dependent Care Credit for care expenses that you need to work. So if you need to work, if your child has to go to daycare, that could count. You probably hear a lot about the Clean Vehicle Credit, which is for qualifying electric vehicles. These rules are complex, so please be sure you are getting with somebody before you are trying to claim this. And so are the Residential Clean Energy Credit for solar panels. Get some water real quick. Let's see. A critical point that I have to point out is the eligibility and documentations. You have to meet the specific criteria for every deduction or credit you claim. Documentation is key. You have to keep records, receipts, statements, mileage logs, charity letters, whatever it is. Year-round planning versus tax season scrambling. This is more of a proactive approach. Tax consequences arise from the decisions made throughout the entire year, not just through tax season. So by planning throughout the year, you can avoid surprises. You could potentially save more, you can reduce stress, and be more informed about your financial decisions. So, some of the key planning areas and strategies. Retirement contribution. That's a big one. If you aim to maximize your contribution to your 401k and your IRAs, understand that the tax differences between traditional and a Roth would help you. Estimated tax payments. If you're self-employed, a freelancer, or even have significant investment income, you're likely to make quarterly estimated payments to avoid penalties, or you need to make it. Tax loss harvesting. Selling losing investments to offset capital gains realized from selling winning investments. So if you know you're going to have some losses and you have those losses, it could help you actually balance the capital gains. There are some specific rules that apply to that, and we can dive deeper on that. Bunching deductions. If your itemized deductions are close to the standard deduction amount, consider grouping the deductible expenses like a charitable donation into a single year to exceed that threshold for the year. Timing, income, and expenses, especially for businesses or even self-employed people. Strategically timing when you receive your income or pay expenses near the end of the year can impact your tax liability. I know you guys probably heard this one too. Health savings account. If you're eligible, HSAs offer a powerful triple tax advantage. So contributions that are deductible, growth is tax-free, and withdrawals for your qualified medical expenses are tax-free. So that's a big one. If you know you're going to use the HSA, it's definitely worth taking advantage of. Now, understanding not only that side of it, but the record keeping side. I can't stress this enough. There are a lot of tax strategies that may be beneficial to you, but won't mean anything if you are missing the tax record side. Be consistent, making record keeping a regular habit. You have to use tools to leverage these, such as maybe an accounting software like QuickBooks, expense tracking apps. QuickBooks has one, Hurdler has one, Wave, or even a spreadsheet. Whatever works for you, find a way to track all of this. If you have a business, separate your finances. You maintain a bank account for personal and a bank account for your business. Those finances, deductions, credits, expenses, everything is separated. Always make sure you have your documents backed up. I use the cloud. So make sure you scan important documents using the cloud storage or even a printed copy, whatever works for you. And if you're using a vehicle for business, you have to keep a mileage log. Any of these apps can automate tracking your mileage, which makes it beneficial when you actually log in at the end of the year to get your P&L statement. They also provide you your mileage log to let you know how many miles you drove that year. Now, you have to keep those records for at least 3 years from filing. But in some instances, you may want to keep it up to 7 years because you actually never know when you're going to get audited. Good planning helps you sidestep common errors that people run into. So now we're going to go ahead and identify some of the frequent mistakes to avoid. All right, you guys, we'll get started here in a second. Common mistakes to avoid. Misreporting or omitting income. Forgetting income. Forgetting to report your 1099 income. Forgetting to report interest, dividends, freelance work, gigs, Uber, Lyft, DoorDash, whatever it is. Just because you don't receive a W-2 for it does not mean you get to forget to report that income or purposely not report that income. The IRS knows that you earned this income. They are looking for you to report it. And the last thing you want to do is get caught underreporting your income. When you are selling stocks like crypto or capital gains or anything like that, you need to make sure you are using the correct basis. When you don't use the correct basis on this, it's actually going to give you the incorrect capital gain or loss amount. And once again, the IRS is catching those who receive cash payment or income from side hustles or income that is received from Cash App, PayPal, Venmo, any of those. They now have the 1099-K tax form, which you are now required to report that income. Get with the tax professional if you receive the 1099-K, because it's a gray area. We know that a lot of people use these third-party apps for personal reasons or for repayment or to send somebody birthday money or whatever it is. But the IRS whole idea behind it is to try to catch those who may be running a side business and receiving income through these apps to avoid paying taxes on it. Another mistake is missing out on eligible tax deductions or credits because you are unaware of the qualifications. Overlooking carry forward deductions that are carried forward or credits from the past tax year. And then not knowing the difference between your standard deduction and your itemized deductions and which one you should take. Choosing the wrong filing status is also a big one. A lot of people miss out on, I guess you would say, taking advantage of head of household when they are eligible. And sometimes it gets a little confusing when you just got married and you don't know whether or not to file separately or jointly with your spouse. So know that sometimes choosing to file separately could result in a lower tax liability. So you kind of got to figure out what best fits your situation. Now, filing separately sometimes could be necessary depending on your status. So if your spouse, let's say, has tax debt, they owe child support, they have student loans, they owe the IRS, whatever it may be. If you file separately, the spouse would be liable for it. and you wouldn't. But knowing that married filing separately also could disqualify you for certain credits, which may lower that refund. So you kind of have to work both scenarios and find out what's going to work best for you in your situation when you are filing with a spouse. Math errors and typos is a big one. If you are incorrectly typing in Social Security numbers, your return could be rejected. If you had the wrong bank account number, it's going to take them forever to process your refund and to give you a check. And a simple calculation error that could be made through a software can also red flag your account. Now, filing late or paying late, that can give you a failure to file and a failure to pay penalty. Interest. This adds up. If you had unpaid taxes and penalties, interest adds up over time. And remember, tax extension. Form 4868 gives you more time to file your return if you don't have time to file by the due date. Keep in mind, that does not give you more time to pay the amount that you owe. That is still due. But filing this extension gives you 6 more months to file your return. If you guys haven't already, go to my video. There's a video on my page that tells you how you can file your tax extension online for free to avoid paying any penalties or to avoid paying the failure to file or failure to pay penalty. Get that done and then pay if you owe any taxes. Here's a big one that a lot of people don't realize that they do every single year because they want their refund. Filing too early. Rushing your tax return. That we know that your tax documents are supposed to be sent out by January, the end of January. But just because they were sent out don't mean they were received. They could easily get lost in the mail. Your tax document could have a misspelling, a calculation error, whatever it is. You have to take time to make sure that you received all of your documents, because sometimes we do receive them later. Make sure all of your spelling, all of that is correct. If it is not correct, you have to take the time to get with them to get a corrected tax form. Okay? You want to make sure that you are in the know about the updated tax laws, because there were a lot of people this year that were unaware about the 1099-K and they actually received it, but they didn't claim that income on their tax return. So when that happens, we have to go back and amend their tax return to update their taxable income amount and to include the 1099-K amount. So before you rush to get your taxes done, make sure you have all your documentations. Make sure you are updated on the new tax laws and requirements and whatnot. Here's one thing to keep in mind: how to avoid penalties and IRS flags. So at this time, you want to prioritize that everything is correct. All entries, everything, social name, all of it. Maintain solid documentation for all of your income, your deductions, and credits. And if you ever receive any IRS notices, you have a certain amount of time to respond. Respond within that window. So knowing these mistakes help, but so does knowing where to find help. So now we're going to look at the tools and resources that are available to you to be in the know.